QuickBooks Online 2025. Correct a normal check entered with an incorrect amount versus correcting a paycheck with an incorrect amount. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation, opening up the major financial statement reports located on the left-hand side. Within the standard reports favorites section, we're going to be right-clicking on the balance sheet to open a link in a new tab. Right-click the profit and loss, otherwise known as the income statement, to open a link in a new tab. Tabbing to the middle, closing the hamburger. We're now in the modern mode as opposed to the classic mode, which you could still switch to at this point in time. The modern mode now being the default. Selecting the drop-down because I want to choose a custom date range tab. Going from 01/01/25 tab, 01/31/25 tab. And if it doesn't refresh automatically, which it should, we can refresh it over here. Tabbing to the right, repeating the process, selecting the drop-down to get a custom range, custom date range, going from 01/01/25 tab, 01/31/25 tab. If it doesn't refresh, we can run it to refresh it over here. Now, last time we processed our payroll, remembering there's two basic ways we can do the payroll within QuickBooks or with a third-party provider helping us to process the payroll. Now, we want to think about an idea of what if we had an error with the check, which in our case happened to be a payroll check, but I want to think about the different scenarios of a check that might have been entered in the prior period versus a check that's entered in the current period versus a payroll check, and different ways you might approach fixing that particular check. So in our case, we had our worksheet to help us process entering the payroll check, not with the payroll process system within QuickBooks, but to just kind of mirror what might be the process of payroll if we had like a third-party provider provide us with the information and then we're entering it into the system to get our financial statements correct as they process the payroll. So this amount was incorrect in my worksheet. So I'm going to make this amount for Erica Smith income tax, the federal income tax withholding $360, and then now the new net check is $1,856.40. Now, when I put this into the system, I put it in with the incorrect amount. Now, first of all, if there was a check in the system with the incorrect amount, how would we find out? Normally, it would be with a bank reconciliation, meaning we're going to reconcile what we put in our system to what was entered into the bank, possibly with the help of the bank feeds. And there's going to be a discrepancy, and we're going to say, okay, there's a problem. And so that's when we would often identify the issue. Now, note that sometimes you have checks that were entered like in a prior year, right? They were entered last year or something. And we're recognizing every time we reconcile our bank reconciliation that we have these checks that never reconcile. And at some point, we're going to say, well, they're never going to clear. So what I need to do is void them so that they're not always as an outstanding check at some point, right? Now, the problem is if I go in and void the check, which is kind of equivalent to deleting it without making a transaction to compensate for that. We go over this problem, by the way, in a prior course or section in terms of how to enter a voided check, but just a general description here. Notice the problem here is like if I was doing my financial statements in order to process my tax returns and say at the end of 2025, I used this net income number to do my taxes, that means I've basically finalized the income statement. Well, what if next year in 2026, I realize that this check is incorrect and I want to fix it so that I can do the bank reconciliation, because maybe I didn't do the bank reconciliation yet. I should have done it before I finalized the year, but let's say we didn't do the bank reconciliation, and so now this is wrong. Well, if I go in here and adjust the check or delete the check, it's going to impact the net income, not in the year I did it, which is 2026, but in the prior year, right? Now, why is that a problem? Notice that if I go to 2026, this income statement is going to zero out, right? If I go to 01/01/26 to let's say 12/31/26 and run it, there's nothing in the income statement. Why? Because it closed out to the balance sheet. And if I go to the balance sheet, we can see that same idea down here where the net income is currently in here at 588144. If I go to 2026, 010126 tab, 123126 tab, and refresh it, then that net income rolled into retained earnings. So if I go in there and I change or delete something that impacts the income statement in the prior year, it's going to adjust the prior year income statement. And that would mean that in order to capture that in what I use the income statement for, external reporting and taxes in our case, I'd have to go back and amend the prior year tax return. I don't typically want to do that, right? Because that's too much work. What I want to do is make the adjustment to affect the current year's financial statements. Now notice, as a bookkeeper or tax preparer, you can identify this issue by basically taking their QuickBooks file and running it as of last year, right? To see if the retained earnings rolls forward. So if I was working in 2026, I might try to run I might want to run the balance sheet as of the prior year. I'm going from 010125 to 123125. And then I'm going to look at their retained earnings in the prior year and see if it changed. So I will have my information that I used in order to do the taxes last year, and I will have my ending net income as of the end of 2025, but I ran the report in like April when I did the taxes, right? And now we're saying it's April after 2026. I'm going to get their QuickBooks file and run it as of 12/31/2025. So I'm running the same report, but I'm running it not in April of 2026, but April of 2027, right? And then if this retained earnings is different than what I had in my worksheet, then I'm going to say, oh man, what did they do? They deleted something. The retained earnings isn't rolling forward correctly. And then you could go in there and fix it. How could you fix it? Well, you could just kind of take all your balance sheet accounts and look at the difference between all the balance sheet accounts, which will give you like a journal entry, which might give you an idea of what to fix, how to fix the problem. But basically, usually, it's going to be some kind of income statement account that you're going to have to hit in order to reconcile your retained earnings to what it was last year. Now, notice that a small business, just to point this out, might not have, they're going to skip this or miss this a lot of the times because all you need on the tax return is your Schedule C, which is just an income statement. So if you have just an income statement and no balance sheet and no reconciliation of the retained earnings, you won't catch it. And that means many small businesses are probably making a lot of errors, because small businesses do this all the time. They delete stuff that was in the prior period, and then when they do their taxes, they don't realize that they should be fixing the retained earnings, and it will result in either not recording expenses or double recording expenses for the things that they deleted. So that's the first thing to note. If you're looking at adjusting a check or anything, if it was in the prior year in particular, which you already made tax returns for, you've closed it out, or in the prior month or quarter, if you do quarterly reporting, then you have to make sure that you void it and then enter it back into the system so it impacts the income statement in the current period, which we go into detail on in a prior course or section. So that's the first thing we want to point out. Now then, the other thing to point out is, well, what if it was just like in the current period? And maybe like this would happen, for example, if I was writing a check with my checkbook and then I wrote the check correctly, but I entered it into my QuickBooks system incorrectly. So instead of processing the checks through QuickBooks, I'm writing the check by hand, and therefore I resulted in an incorrect data input into the system versus what I wrote by hand. And when would I catch that? When the check clears the bank, I would see that there's an inconsistency. If I determine that the bank is correct, then usually to have a full audit trail, I should void the check and re-enter it. But in that case, it's like it'd be a lot easier, and QuickBooks allows you to be able to change the check, right? Because it's not for a prior period, and it's because I just did a data input error. So sometimes, you might do that. So that's one thing to keep in mind, that you might just go in there and adjust the check. However, if it's a paycheck, If you process the paycheck through QuickBooks, and there's an error in the paycheck, the data input on the paycheck, then you would think, well, maybe I could go back into that particular check and change it. But for a paycheck, you can't normally do that if you process the paycheck within QuickBooks. And that's because the paycheck is feeding into all of these reports, and the reports are including like caps on some items, like the FUTA, federal unemployment tax, has a cap that has to be hit. And if you delete the check or change the check, then the system might not be able to pick up all the information for all the registered reports in order to get your 941s correct, 940s correct, and so on. So if it's a paycheck that is wrong, then you almost certainly have to void the paycheck and reprocess the paycheck, possibly being able to process just one paycheck, right? So if I did, for example, this payroll for 2 people, and then one check was wrong, I might be able to void that particular check and then reprocess the payroll for that one check. What I don't want to do typically is try to go in there and fix the paycheck, because it's going to mess up all of the other kind of reports that I need in order to reconcile the 941s, the 940s, and all that kind of stuff. Now, if an external person, like an ADP or a Paychecks, they're the ones doing all the reporting and whatnot, and then we just entered it into our system like incorrectly, like I did here, well then it would be like a normal check, even though I'm mirroring what happened on the Paychecks from the system, and it would be like a normal check that I can possibly just adjust if I see that incorrect data input, which I would probably find once again when I do the bank reconciliation. So let's go ahead and do that. I'm just going to go in and say, okay, how can I fix it now that I've ranted 010125 to 013125. Let's go ahead and find the check. So I'm going to go into the payroll expense, and the check was for Erica. So let's just go into it, and I'm just gonna adjust it. So QuickBooks makes it really easy, almost too easy, to just go in here and adjust the check. Now this particular check had 2 items related to it. So we had the expense, which was the $2,400, and then the taxes, which used to be these 3 added up, 5, but now I changed this amount. So now this should be $543.60. $543.60 for the payroll liabilities, which you can see here as well. Okay, so $543.60. So I'm going to say negative 543.6, and that should give me the net check of 1856.40. So that gives me the net check of 1856.40. So I think that we're lined up now. I think that's it, and we're lined up. So let's go ahead and save and close that so you can see how easy that is to do. Again, though, that wouldn't be easy to do if it were actually processed through payroll. You'd have to void it, and it wouldn't be something that you would want to do, although it would be easy to do if it was in a prior period, because it's going to mess up your retained earnings and your income statement for the last year that you already closed. All right, let's go back. Now, just a couple other types of checks. Remember that any check that's connected to something else is going to have that problem. So if I look at the forms up top, like expense forms and check forms are kind of the same, right? Because they're usually things for normal expenses, utility bill, the telephone. The check form just has a check number if you actually write physical checks, but both forms are decreasing the checking account. But any kind of decrease that's tied to something else is going to be a little bit more complicated to just change. So for example, if you had the bill pays form, it's a check type form, but it's connected to the bills. So most likely if there's a problem with this one, you're going to have to void the check and re-enter it because of the connection to the bills. We also could have a payment for the payroll taxes, which is going to have, again, a special widget. So you'd have to kind of delete it, even though it's a check form. Same with the sales tax. If you process the sales tax and pay the sales tax, you're usually not going to pay it with a normal check, but instead with a special check widget And that means that if you're using the special check widget, you're going to have to delete the check if there's something, or void it if there's something wrong with it, and reprocess the sales tax within the widget. So any kind of check that's kind of connected to some other process, you want to be careful about just, voiding it or deleting it or changing it. Any form is similar, by the way. So if you had like an invoice and then a received payment, if there's something wrong with either of these forms, then you're going to have, you can't just, like if you enter the invoice incorrectly and then you entered a received payment, which has been tied to the invoice, you can see why there's going to be a problem if you then adjust the invoice after you've already entered a received payment. So in that case, what you'd have to do is delete the received payment or void the received payment, and then adjust the invoice and then enter the received payment again, right? Or something like that. So anytime there's those connections, got to be careful with adjusting things. All right, so this is where we stand at this point in time. So we'll just recap it here. So there is where we are. See if I could just scroll through. I'm trying to get used to this new report format. Here's the profit and loss at this point. And then let's go to the first tab and open the trial balance just to take a quick look at the trusty TB, baby. We're going to say trial balance, not tuberculosis. All right, and for some reason it does this wacky trial balance, so they need to fix that. Fix that, QuickBooks. It's ridiculous. But I'm just going to go to the classic mode for now. Switch to classic mode. And then change it to the date range 01/01/25, 01/31/25. Run it to refresh it. So this is where we stand at this point in time. Balance sheet on top of the income statement. Balance sheet including assets going from the checking account down to the accumulated depreciation, which is the contra asset. And then the liabilities going from the accounts payable down to the payroll liabilities. And then the equity opening balance down to owner's equity, which is equivalent to the retained earnings if it were a corporation instead of a sole proprietorship, which it is. And then we have the income statement, income minus expenses. If I took the two income accounts, the two credits minus all of these debits, which are the expenses, I would get to the net income reported on the income statement, which will automatically close out at the end of the year. Not month by month for QuickBooks. It's going to close out automatically at the end of the year. So if I ran this report for 2026, these accounts would be gone, the net income rolling into the owner's equity, which hopefully gives you an idea of the problem of deleting things, right? So, and I just want to point this out, like if you're a tax preparer or particularly a tax preparer, a lot of tax preparers aren't great at really doing a couple checks that can be really helpful for businesses, right? They just do the data input. Give me your income statement, and I'm just going to data input it. But you can do a few things that can give you a little bit more internal control, because remember, the double entry accounting system itself gives us a lot more internal control. So that's one big internal control. Helping a client to reconcile their bank accounts, even if they use the bank feeds, is another huge internal control. And the next thing we can do pretty easily is roll over the retained earnings. Check their retained earnings that they reported here to what they gave us last year, which may not be on the tax return if it was a Schedule C, but you might have it, I would record it in your worksheets, right? And then check to see if their retained earnings rolled over correctly. If it didn't, then most likely you're going to, if you don't take that into account, you're going to input the income statement incorrectly, because there should have been an adjustment to income because you either overstated or understated, most likely, the expenses in the prior period, right? And the other check that we can do that a lot of people don't do, but it's so easy, it's something that we'd want to do, is the payroll expenses and the payroll taxes. We should be able to tie these out to the reports at the end of the year. So I would have them provide to us the W-2s, the W-3s, and the 941s, which we might be able to get from QuickBooks if we process them within QuickBooks. And I should be able to reconcile these numbers to those reports. And that's important to do because if the IRS comes after us with an audit, they're going to say, hey, look, you got this huge deduction, because usually payroll is a big deduction. Is that a legitimate deduction? And we should be able to provide them the evidence for it. Also, now that you got someone that's not a complete like moron over there, like trying to figure things out, you got Elon Musk over there trying to figure out their computer systems so that they're not doing paperwork in an actual mine at this point in time, then their system should be able to reconcile the fact that we gave them 941s and W-2s and W-3s, and we gave them a tax return reporting our income taxes. Those two things should match. So if their computer system was up to date, like it shouldn't even take a person to see a large discrepancy between like what was reported on our payroll expenses and taxes on our books versus what we reported for our payroll taxes on the W-2s, W-3s, and 941s. So you can see that that's a natural question that we'd get in an audit, and that's usually, again, a big amount that's on the financial statements. And you'd be surprised how many times people don't reconcile, right? People just take whatever they get and they just enter it into the tax return, and it is what it is. But anyways, that's my rant.